Hi, everybody. Welcome to my show. I'm so happy you're here. I'm Freda with J Par Realty, and we're going to really dig into mortgages today and see what's going on in the mortgage world. I know everybody's a little nervous about interest rates, but people are still buying homes, and it looks like it's going to be a wonderful summer this year for real estate. So I'm going to bring Katrina Lusciano in today, and she's with Silverton Mortgage. She does a great job for me. I've used her to help my buyers, and they're very happy. And I'm going to bring her in, and we're going to talk all about mortgages today. So hang on. Hi.
Hey, how are you?
I'm good. How are you?
Doing very well, thank you.
Hey, Katrina.
Yes.
So anyway, we're going to talk about mortgages today, and I'm so excited to have you on. I have a few questions from the audience.
Yeah.
Earlier that was asking me, what type of mortgages do you offer, Katrina?
Okay, so we offer construction financing. So if you want to buy a lot and you have your building plans already prepared, we could actually do it from start to finish, get the lot, turn around, fund the construction project, and then it's already a one closing at the beginning of the project. So you would just end up in the end, we would convert it from the construction loan to the permanent loan. And then the interest rate is actually selected now at the beginning. So that's probably good to safeguard the interest rate. And then we have our regular conventional loans, which are typically for you don't have to be a first time buyer, but I like to have people who have a credit score over 700 to go into a regular conventional loan. You could go as little as 3% down if you haven't owned a home in the last 3 years, let's put it that way. And that would give you the best interest rate. If your credit score is under 700, then I typically would look to the FHA route, which the minimum down payment is 3.5%. But that's going to give you the lowest payment. The main difference with the FHA and the conventional, though, is that the FHA you're going to have to refinance it. Let's put it that way. It has permanent mortgage insurance. Whereas with a conventional, once you get to 20% equity position from whatever the home appreciates to and your balance, then you could get rid of your mortgage insurance or request it to be removed at 20% loan to value or a 20% equity position. The FHA, it will never come off. You do have to refinance it to get rid of it. And then VA, we also have VA loans. I'm so sorry, Freda. And then, so second home, investment property, jumbo loans, which are loan amounts over approximately $676,000.
And you do have those, right? The jumbo loans?
Yes.
Okay. Are the interest rates usually higher on a jumbo loan?
They're not, actually. It's interesting. Although if you only put 10% down, they're going to be a good bit higher. But if you put 20% down and you have decent credit over 700, 720, it's not going to be that much different than your regular conventional loan.
Okay. So I had a question about the new construction. So you're saying that you can lock in the interest rate? I mean, because some homes are taking longer, maybe than 6 months. So can the interest rate be locked in that long?
Yeah, so it is locked in from the beginning. So basically what we're going to do is look at the term of the construction period. Usually it's a 12-month construction period. And then we're going to look at if the current rate today is, let's just say 6%. And a 12-month rate, because once you get past 90 days, then you add so much to the rate. So maybe the 12-month rate is 6.5%. That's not bad, though, because who knows what the rate's going to be in a year. So 6.5% then would be your note rate. So when you're going through the construction process, you're paying interest only on your draws at the 6.5. And then when you're at the end of the 12-month period and it converts to the permanent loan, it's at 6.5%, then on the 30-year fixed rate.
That's not bad. I mean, everybody freaks out about these rates, but as you and I know, I mean, when I got started in real estate, they were 14%, and my first house was 12.5, and I thought I was getting a deal. And now everybody freaks out about 6 and 7. But really, I think they only started coming down during COVID. What were they right before COVID? I don't remember.
Oh
were
my
they
gosh,
like the 5?
We literally had in the mid 3s, 4s. It was pretty decent. Although, I mean, I don't think that prior to COVID, like 2018, 19, I don't think that they were fantastic years. I think that just all that pent up, I guess, just Americanism, people wanting to buy after COVID is what really spiraled all of this activity. And then, of course, the government trying to stimulate the economy because everything was shut down. And then you add to that all of the extra flooding of the market with stimulus checks. So that's really what created the inflation. We should have increased the rate ahead of time.
Yeah. Those are crazy times. I thought for sure when COVID came about, I thought the market was going to like go down, but it didn't. Everybody wanted to buy a house, and a lot of people didn't want to put their house on the market. So it was crazy, right?
It really was. Yeah. We had so many lenders for the jumbo financing just shut their doors, not shut their doors, but just, we're not going to finance anything. So literally people were scrambling, trying to find jumbo money. And then we do offer a combination first and second mortgage as well. So we were trying to figure out how to do a first mortgage and then a second mortgage and get people under that conforming loan limit so that they could still get that jumbo house if they didn't have that extra cash.
Right. And I know that there is some mortgages for doctors, but they're really not that good, right?
Yeah, so we had a source, I was going to say one of our lenders, Truist Bank, they offer the physician loan. I have found that it's not a lot different for us on the retail side, unless you are a Truist, I want to say high end. They really want your business is what it is. They want your checking, your savings, your investments, and then they're more apt to work with you with a little special loan that they will hold. But I know it's a shame. I feel like we should have a little bit more. Really, the big thing with the physician loan too is that we're not going to look at the student loan debt, which a lot of times can be very high for a doctor. So that's probably one of the differences.
So I know, Katrina, this show's not going to air for another 2 weeks, but what are the interest rates, the average interest rates right now? And does that depend upon your credit score? I mean, do you get a better interest rate if your score is better?
Yes, it does. Yes. I know that there's been a lot of course, media talk of the new loan level price adjustments and that people who have lower credit scores are getting a break and that people who have excellent credit and have paid their bills are being penalized. They're actually having to stay at the same level that they were paying. So it appears that they are actually providing the funds for the people with the lower credit. The government is trying to help lower credit folks to get into homes. I'm not seeing where it's a big difference. Pretty much if you have, it's tough because if you have over, again, like I was saying before, a 700, then more than likely I'm still going to put you in conventional. If you're under that, then I'm probably going to look at the FHA. Even still with these loan level price adjustments, it's not that it's made earth-shattering difference for the lower credit score folks. And I think the people with the higher credit scores, this was something that actually happened after the mortgage meltdown in 2008, where the government, of course, needed to be bailed out, Fannie Freddie, from all of that mortgage meltdown. So that was one of the things that they did, was start adding loan level price adjustments. And so it's been creeping in anyway, right along. I think to the outside world, you just didn't see it before. And now it's front and center.
I thought that was fake news. For
Yeah.
real.
Yeah.
But I guess it's not, huh?
Right.
So a lot of people are wondering also, like, what are terms and conditions for the mortgage loan? And I know they're all different, you know, according to what you get, but can you tell me the basics?
Yep. So I have not seen, I've been doing it for 30 years, but in Georgia, really, it still is we're a state where if you don't pay, you don't stay. So I don't see too many variations of loans other than a 30-year fixed, or maybe a 20 or a 15-year. The adjustable rates were attractive. We used to have a balloon note. I don't know if you remember those days. I thought they were great.
Oh, yeah.
It was fixed for 5 years, and then it went fixed for 25 years, or a 723. It was fixed for 7 years, and then it went 23 years fixed. But those went away, and then the adjustable rates came in. But the adjustable rates, the problem with those is that if it's fixed for 5 years, then in year 6, 7, 8, it's going to adjust, and you could go up 5% in that year 6, for example. So I think for most folks that I talk to, the difference is not that great. It used to be maybe 2% difference between a start rate on a balloon or a start rate on an ARM compared to the fixed rate. But now if it's 0.25%, even 0.5%, people aren't comfortable going into those variable rate programs. They're very nervous about that. So I honestly see a 30-year still, because of the no prepayment penalty, where most folks just go with that. And then if they want to pay down extra, they can. But especially after COVID, they're not boxed into that higher 15-year payment if they don't have to be, even though the 15-year rate, of course, would be a better rate than the 30-year. But it's not, again, it's probably at the very most a 0.5% better. So most people would just rather have the comfort of a lower payment on the 30-year and be able to just pay down extra as they want. Also, just to note, every lender now, or should I say servicer. So when you close on your loan, like for example, we'll close in our name, Silverton Mortgage, but we could sell the loan. And it doesn't change any of your terms. It just depends on who you're making your payment to. And we went through a period where if somebody said, you know, hey, I want to drop an extra $10,000 on my balance, can I do that? And yeah, you can. It's just going to shorten your back end amount, that your term. But now the lenders all allow for recasting, which is pretty cool, because then if you do drop an extra amount on it, which typically you would want to do, I would think 5,000, then it's a recast department, and you would just mail them your extra money, and then they would take your current balance at that time with your remaining term, and then what your rate was, and then that's your new payment. So I think that that's attractive. So that at least allows people not to have to refinance if they don't want to, and spending all the money on additional closing costs.
I think that's really great. And also, like, I think some of my buyers used that when they were buying their house first, and then they sold their house later, and they had all this money they wanted to put into that mortgage. And then you just it's called recast. Is that correct?
Recast. Yep. And you're absolutely right.
Yeah.
That's what, especially in a market where maybe a seller didn't want to accept a contingent offer. So you're right. We would go ahead and do the new loan as a primary residence, and then turn around. And once they exited their other property, they could put down whatever they want.
Yeah, I love that. I remember, I think several years ago when I first heard about it, and of course you were the lender, and I just thought that was an awesome idea, you know, and they didn't have to do the refinancing and things like that.
Yeah. The other thing too is with the rates coming down, or if they come down, I should say, for us, we are doing no lender fees if you refinance it, or with us or with me. And then also with the state of Georgia, there's a transfer intangible tax that is $3 per thousand of the loan amount. So because we close in our name as the lender, if I refinance people, then I'm going from Silverton to Silverton. I don't have to pay that Georgia intangible tax again. So that is huge, because the $1,400 of your lender fees, which is your credit report, underwriting, processing, we just lump it all together. But that plus your $3 per thousand of your loan amount, that's potentially $3,000 of closing costs. So you would only have the attorney fees, which most, I go back to the same closing attorney. So it would be reduced closing cost.
Yeah, that's awesome. That's, I mean, it counts. I mean, that adds up, you know, every little bit. So,
that's right.
So how much, okay, so down payments are different. VA is zero down, except there's a funding fee you can finance, right? Explain to me about all the different financing and the down payments. I mean, you did explain about financing down payments,
so
I guess.
Yep. So VA would be for a veteran. And we have no lender fees to the VA loan. So that's a $1,400 plus savings. And then if you are a veteran and you're receiving any disability income, even if it's $10 a month, you don't have to pay that funding fee. So that's wonderful. The funding fee is what, instead of PMI, okay, so you could put zero down and you don't have any mortgage insurance. And mortgage insurance is there to protect the lender in case you default. And statistically, if you put less than 20% down, then if the lender defaults, by the time they pay their attorney fees, maybe somebody hasn't made payments in a year, that's where that 20% came from. Basically, it is an amount that if somebody defaults, the lender feels that they're going to at least be able to get 80% of that loan to pay off the loan, rather, on the sale, after they pay the attorney fees and the back interest. With a VA loan, you don't have that. So you end up with a funding fee, which they just renewed these. I believe it's 1.7% now that gets added. But yes, we just added on to the loan amount. I've never had a vet say, oh, you know, if they can do a VA loan, they're going to do a VA loan, even with the funding fee. So FHA, interesting enough, they have two parts of this mortgage insurance premium. They have an upfront one that's 1.75% that gets added to the loan amount, or you can pay it cash, but nobody ever does that. But that gets added to the loan amount, and your minimum down payment on FHA is 3.5% down. So you add that, the 1.75, and then you have a monthly mortgage insurance of a 0.55 factor. So it's like 0.55 times the loan amount divided by 12. That's your monthly mortgage insurance. Then compared to conventional, it's 3% down for your minimum down payment. And you cannot have owned a property in the last 3 years. That is the criteria for that. And then there's no upfront mortgage insurance on conventional. It's only monthly. But as I said in the beginning, if you have a less than 700 credit score, that monthly mortgage insurance gets pretty expensive. So most times when I run payments, it's a huge difference, possibly $200 to $300 a month in a payment difference going from a conventional or from an FHA to a conventional. So with that, I would just tell people, do an FHA and then we'll refinance it down the road. But yeah.
Anything else you wanted to add to that?
I think just to say too, we have the rural loans. So there's USDA, which is 100% financing. But the difference there, though, is it does have to be in an area that we put in the address. And there's like pocket areas outside of Metro Atlanta, none in Metro Atlanta, but outside. So if you're in Barrow County, Walton County, maybe Dawson County, you could still, though, have two different property addresses in Barrow County, for example, one that would be USDA and one that wouldn't. So it just is. And then USDA also has income limits. There's also the Georgia Dream. So the Georgia Dream is an FHA product. So it is a 3.5% down payment, but the 3.5% down is basically a second mortgage. It's a silent second mortgage to fund the down payment. And then you've just got to stay in that house for, I believe it's 5 years before you can sell and not have to pay back that silent second mortgage. And then with the Georgia Dream, they also have income limits. So it's a little, nothing is clear cut, everything is dependent on your credit score, where the property is, what your income is, which also then, just to throw out there, student loans, everybody's like, oh, I always go through the questions. What is your debt before I run your credit, just to kind of get an idea. And people, oh yeah, I got student loans, they're in deferment. Well, even if they're in deferment, we have to count a payment. So for conventional, there's actually two different lender sources. There's Freddie Mac and Fannie Mae, or Fannie Mae, Freddie Mac. Fannie Mae counts 1% of your balance divided by 12 as your minimum payment for qualifying. And Freddie Mac counts 0.5%. So we offer both, but when I go to run it through this Fannie Mae approval program or Freddie Mac approval program, we really need to know up front then. So that's why when people say, I'm fine, I always say, let me make sure that, what are we looking at here? Now, I will tell you, though, that we can use an income-based repayment plan if the person has applied for that in the student loan. So a lot of people with the student loans have not applied for the income-based repayment plan. You have to go to your student loan folks and give them your income, and then they will tell you that this is how much you can qualify for. We have to have that letter, and we can use that. I had recently where the income-based payment was actually higher than counting 0.5%. FHA is also 0.5%. So I was like, well, let's just go FHA then. I'm not even going to show your income-based repayment plan. So you just never know how it's going to work out, but we try to look at it every which way.
Yeah, I know everybody's different. The situations are different. And I know in Georgia Dream, the people that I have tried to get qualified on before, I mean, I have had some that went through with it, but they qualify for a lot less than on the regular FHA. Is that still true?
Yes, they do. Yes. Yep. And plus the Georgia Dream, it's a two-step underwriting. So we underwrite it, and then you have to send it to the Georgia Dream folks. So it's just, if there's a lot of people trying to get this first-time buyer money, then you're going to have a wait, and maybe that seller isn't going to want to accept your offer because they know that they can have somebody walk in and with a regular. So I always tell everyone, like, do your best to try to get your 3.5% down. You can have a gift from, like I said, a family member, a close personal friend, a non-married partner, or if you're not married, your partner. You can borrow from your 401k. That's completely acceptable. And I've had buyers do that they didn't know that,
Right.
So,
right.
Yeah, the secret is to have the money in your account for 60 days. So if you went and pulled money from a non-acceptable source, which a non-acceptable source is basically any unsecured debt, credit card, installment loan, you can't do that. So you'd have to have that money in your account for 60 days. Then we won't know where it came from. I didn't say that, though. I'm just kidding.
I'm not telling.
Yes.
I'm not.
Yes.
Believe it or not, we just got about 2 minutes left.
Okay, great.
Yeah, we were like, oh my gosh, can we talk that long? So the mortgage process, about how long does it normally take? Isn't it like 30 to 45 days for closing?
No, we have our own appraisal department. So we are, we have the ability to, I now can submit directly to underwriting files. So I do the in answer to your question, I would say 2 weeks because we need really the big issue is going to be getting the title back from the closing attorney. And each county is a little different. Some counties are quicker to get the title, and other counties are a little slower. So 2 weeks would be, 3 weeks is most comfortable.
Yeah.
2 weeks would be like, okay, it's a hot potato. We need to do this. But
get your docs in, right?
Yeah. For us, literally, I could be, 2 to 3 days myself, enough time to get the verification of employment, tax transcripts that we have to order from the IRS, and order our appraisal. But it's waiting for that title, and the appraisals are running no more than 7 days. Some were even getting back. I've gotten a VA back the same day. We do our own VA appraisals as well. Yeah.
Wow. That is awesome. And I know you are awesome. I've used you a lot, and I love working with you because I know you always get the job done. And tell us how someone can get in touch with you to find out more about a mortgage that they may be looking for, or to get pre-qualified for a loan.
Yeah. So my number 678-778-6858. So again, 678-778-6858. Call, text. And my email is Katrina, like the hurricane. So Katrina.Lusciano, which is LUCISANO at silvertonmortgage.com. So Katrina.Lusciano@silvertonmortgage.com. And I'm on social media, Facebook, and LinkedIn. So feel free to, most times Katrina, Silverton Mortgage, I'm the only one. You'll find me.
Well, thank you. I love your last name, by the way.
Oh, thank you. Like yours. Yes. I love it. Yeah. Just flows, right?
Yeah. So anyway, thank you so much for taking the time and explaining more about the mortgage, different mortgages and everything. We appreciate your help, and I hope you have a wonderful day.
Well, thank
Katrina.
you. Thank you for having me, Freda. I really appreciate it. Thank you so much. All right.
Bye-bye.
Take care. Bye-bye.
You too.